welcome back to Iron Financial. If you're new here, make sure you hit that subscribe button because our mission today is absolutely crucial. We're going to help you forge a stronger portfolio and cut right through the market weakness. Today, we're diving into a full, data-driven explainer of a massive and frankly baffling anomaly in the market. We're talking about Cisco Systems' fiscal Q4 2026 earnings. We're going to go through these financial statements line by line, zero in on the structural stress points, and figure out exactly what the smart money is doing here. So let's just start by looking at the sheer disconnect between the company's performance and the market's absolutely brutal reaction. I mean, Cisco just dropped a massive beat and raise. Their Q4 non-GAAP EPS came in at $1.22. That completely crushed the 117 consensus. And we're looking at record quarterly revenue of $17.3 billion. That's up 18% year over year. Think about that for a second. A company of this massive, legacy scale dropping double-digit top-line growth. That is a phenomenal structural feat. And yet, the stock just tumbled. It fell 7% to roughly $115 right after the print, which basically unwound a huge chunk of their incredible 63% year-to-date run. The market literally saw those record top-line numbers and just panic sold.
Right, and as the market skeptic here, I've got to step in and ask the really tough questions. Because management can frame this with all the optimistic spin they want. But a 7% drop on a record revenue print, that is a glaring red flag. Wall Street doesn't just accidentally wipe out billions of dollars in market cap when a company is breaking revenue records. So what's going on? Is this margin drop we're seeing a literal crack in the foundation of Cisco? Or is this simply the heavy lifting price tag of building an absolute AI monster? We have to get some clarity here that goes way beyond management's rosy guidance.
Exactly. So let's jump right into section 1, the blueprint, focusing on the top line and that AI machine.
Now, before we start diagnosing any potential cracks in the armor, we have to actually quantify the sheer load-bearing volume that Cisco is currently pushing through its pipeline. Let's get some historical context here. Cisco just achieved a record fiscal 2026 revenue of $63.3 billion. That's a 12% increase year over year. CEO Chuck Robbins even came out and noted this was their absolute strongest year in 3 decades. They delivered the highest employee productivity metrics in 30 years, and that's across revenue, operating margin, and earnings per employee. On a GAAP basis, net income was up a staggering 51% in Q4 alone. So their operating leverage is just firing on all cylinders right now. The core structural foundation of the company's earning power, it's undeniably solid.
And then we have this number, 40%. That is the year-over-year surge in networking product orders for Q4 alone. We are now seeing 8 consecutive quarters of double-digit growth. So look, this isn't a one-off fluke, and it certainly isn't just a temporary pull forward in demand. What we're witnessing is the heavy lifting of a multi-year networking supercycle. Total product orders were up 35%, and enterprise orders accelerated by 21%. They are seeing broad-based, relentless demand across every single geography and every customer market. Basically, legacy hardware refresh cycles are violently colliding with next-generation network architecture requirements, and it's creating this massive tailwind for them.
But here is the true load-bearing pillar of their future, $9.3 billion. That is the total for hyperscaler AI infrastructure orders in fiscal 2026 alone. To put that into perspective, that is a jaw-dropping 4.5 times increase year over year. Now, even if you exclude the hyperscalers entirely, their product orders were still up 25%. But this $9.3 billion figure, along with 3 brand new hyperscale AI design wins they just secured, it proves they are a central, dominant player in the global AI build-out. They aren't just selling to secondary players here. They are quite literally embedding themselves into the core infrastructure of the largest tech companies on Earth. Let's actually track how this AI volume engine is sequentially scaling up, because it's pretty wild. In Q4 alone, Cisco took in $4 billion in AI infrastructure orders from hyperscalers. They delivered about $4 billion in recognized AI revenue for the full fiscal year 26. And looking ahead, they're projecting a massive $7.5 billion in AI revenue for fiscal 2027. The sheer volume of these hyperscaler orders is feeding directly into a highly lucrative multi-year pipeline. This backlog effectively locks in their top line for the next 18 to 24 months, which gives them an incredibly rare level of revenue visibility in what is otherwise a really volatile macroeconomic environment.
Okay, hold on. Let me jump back in here. Because it is incredibly easy to get totally blinded by the phrase billions in AI orders. But I'm looking at the stock chart, and it is bleeding. If demand is supposedly so high and sales are spiking this hard, why are margins compressing so violently? Is this AI boom actually generating real sustainable profit, or is this just hyperscaler hype that's secretly eroding the bottom line? A $9.3 billion order book means absolutely nothing if the unit economics don't actually make sense. We really need to pivot to the stress points here.
Which brings us perfectly to section 2, the structural stress, and what I'm calling the margin crack. I want to aim a laser focus on these financial statements right now and see exactly where this armor is breaking down. Because honestly, this is what triggered that massive 7% plunge. Total non-GAAP gross margin fell to 66.3%, down from 68.4% a year ago. For a mature mega-cap tech company like Cisco, a 210 basis point erosion is brutal. And product margins took an even harder hit. They fell 270 basis points straight down to 64.8%. Oh, and the warehouse, it's literally overflowing. Inventories swelled massively from $3.16 billion up to $5.69 billion. That is a massive amount of free cash flow trapped in physical hardware just sitting on shelves, carrying heavy obsolescence risk in a really fast-moving AI cycle.
And the tough reality is, it gets worse before it gets better. This margin compression, it isn't over. Management actually guided Q1 fiscal 2027 non-GAAP gross margins even lower, down to a range of 65% to 66%. And why is that? It's because they're rapidly scaling up this lower margin AI hardware mix. Think about it. Selling bulk hardware to hyperscalers involves cutthroat pricing power dynamics. These mega clients, they demand massive volume discounts. Plus, the hardware itself requires incredibly expensive internal components. Combine that structural headwind with totally stagnant, flat services revenue at $3.79 billion, and suddenly they have no high-margin software cushion to pad the fall. We are watching a severe trade-off unfold in real time. Massive volume growth resulting in direct, potentially permanent product margin dilution.
Well, fair points. But I want you to listen to how CFO Mark Patterson frames this exact issue. He notes that shipping high volumes of hardware increases the revenue mix to hardware and creates a slight gross margin headwind. The absolutely crucial point here is that this headwind is just the expected temporary cost of securing a massive scale hyperscaler footprint. It's a strategic land grab. You win the hardware footprint today, even if it's at a lower margin, so you can sell the high margin software and recurring services tomorrow. And furthermore, operating margin actually hit a record 35.9% in Q4, and that's because they are ruthlessly managing their operating expenses. So profitability at the core operational level, it remains completely intact. Let's shift gears to section 3, the battleground. Looking at the FY2027 outlook and the absolute war happening on Wall Street. We need to zoom out a bit here to look at the forward outlook and the complete divide tearing through Wall Street right now, because the forward guidance proves this structural foundation is bulletproof. Cisco is guiding for $72.2 billion to $73.4 billion in FY27 revenue. That's roughly 15% growth at the midpoint. Operating margins are expected to hold near that high water mark of 35%, and despite the inventory swell you pointed out earlier, they just returned a staggering $12.7 billion to shareholders in FY26. That represents 99% of their free cash flow. That is an absolute fortress of a balance sheet. Plus, management confirmed they have no lead time issues, and they maintain direct supply ties with TSMC, which means they control their own destiny in the supply chain. Yeah, but Wall Street is completely fractured on this. I mean, look at this table. You have Rosenblatt throwing out a massive $165 bullish price target. Wells Fargo is right behind them at $150. Then Morgan Stanley and KeyBank are clustered at $135, with KeyBank actively warning that the stock might just be range-bound due to the margin step-down. And then you have Barclays all the way down at $123, remaining highly cautious. Look, this isn't just a minor disagreement over a few cents of EPS. This represents genuine fundamental disagreement among the smartest institutional minds on how to value this entire company. Do you reward the massive top-line AI volume, or do you punish the deteriorating margin profile? Right. You really have two diametrically opposed camps here. On one side, Rosenblatt argues the underlying growth trajectory is stronger than ever. They are focusing entirely on that load-bearing AI volume and the 15% revenue growth projection. They fundamentally believe the market share capture is all that matters in this early phase of the AI supercycle. Meanwhile, Barclays is hyper-focused on the exact structural stress I've been pointing out today, the AI dilution risk in FY 2027 product gross margin. If $1 of revenue today brings in less profit than $1 of revenue yesterday, the actual quality of your earnings is degrading. The street simply doesn't know which metric matters more right now. And before anyone tries to chalk this up to a sector-wide tech collapse, we really need to look at their peers. Cisco tumbled 7% specifically on these gross margin fears. Meanwhile, rival Arista Networks, who, by the way, reported a strong Q2 just last week and raised the bar, they slipped only 0.7%. Even other legacy networking peers like Ciena were up 3%, and F5 is up 66% year-to-date. This was a very specific, targeted repricing of Cisco's unique margin structure. The market is looking at Cisco's competitors and deciding that they are navigating this hardware-to-software mix much more profitably.
All right, that brings us to Section 4, the verdict. Is this long-term strength or a margin trap? So we've audited the top-line revenue, we've probed those margin cracks, and we've mapped out the Wall Street battleground. It all comes down to one ultimate tension: volume versus margin in the AI networking supercycle. From my perspective as an analyst, near-term margin compression is simply the acceptable heavy lifting required to capture dominant market share in a multi-year build-out. Look, you don't build a $7.5 billion AI pipeline without pouring massive amounts of concrete first. And this lower margin hardware, it is exactly that concrete. The operating margins and cash flows show the overall business model is highly resilient to these gross margin fluctuations. At the end of the day, cash generation isn't in danger. As you can see, we're looking at record-breaking networking revenue of $9.79 billion, up 28% year over year. Even if the gross margin percentage takes down a point or two, the absolute sheer volume of cash generated from a 28% increase in networking revenue is structurally massive. They're bringing in way more absolute dollars, even if the percentage take on each of those dollars is slightly lower. They are aggressively and successfully self-funding this entire supercycle right out of their own operations.
That's true, but as an investor, you have to watch the tripwires carefully. The bull case relies entirely on this being a short-term, contained margin hit for long-term AI volume dominance. The bear case fears that this lower margin hardware product mix dilution persists far longer than management is signaling, which would permanently impair long-term earnings growth. So your core watch heading into the fall reporting cycle is simple and it's pretty binary. Will Q1 65% to 66% gross margin guide actually be the bottom floor? Or is it just the start of a multi-year downward trend as they're forced to continuously compete on price just to get hyperscaler business? Exactly. Which leaves us with the ultimate provocative question for your own portfolio. Is Cisco's 7% pullback a golden buying opportunity to acquire long-term AI infrastructure strength at a major discount? Or is it a value trap heading straight into a prolonged multi-year margin squeeze? You need to weigh the hard data, watch those upcoming Q1 margins absolutely like a hawk, and forge your strategy from there. Thanks for joining us on this explainer, and we will see you next time right here on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.